Hey guys, welcome back to another Property Tank. Pumped again, keen to get into a new week in property. Today we're going to be talking about investing in houses versus units. The age-old question, houses versus units, yields versus capital growth, okay? Also, we're going to get into negative gearing, okay? What does that mean? What is negative gearing? People have been doing it for eons. What is it? How do we get involved in it? And who's it going to benefit? All right, guys, let's crack into the episode. Remember, if you're doing a knockdown rebuild, dual occupancy or multi-unit development site, please book a consultation below. We're the experts. We can help you. We can make sure that your investment is safe and maximized. Also, get across to Instagram. Come say hello. Lots of value coming out there all the time. You can keep up to date with everything we're doing. Also, the most important one, make sure you get involved in littlefishnetwork.com.au. Become a fish. It's free. And there's heaps of community members in there. It's the biggest property community in Australia. So get involved. Thank me later. All right, guys, let's get into it. Negative gearing. So this has been a tool that property investors have used for years and years. And so rough numbers, if you rent the property out for $1,000 a week, that's around $50,000 of rental income per year. But if it costs you $60,000 in interest repayments, land tax, property management fees, maintenance, things like this, you've incurred a $10,000 loss essentially there. So that loss you can take over to your earnings over on this side and take that off your earnings that you pay tax on and essentially save the tax. So if you're in a circa 40% tax bracket, that $10,000 of losses will essentially be a $6,000 loss rather than the $10,000 loss because you've saved $4,000 in tax. They're just round numbers, but that gets you heading in the right direction. So essentially, investors are able to invest in property, invest in an asset that hopefully appreciates over time. History suggests it does. So that appreciates over time here. But negative gearing gives people the opportunity and more so the ability to hold on to these assets because they have these tax benefits. So it definitely makes it easier for people to hold on to. And essentially, the more money you earn, the higher tax bracket you're in, which means your savings are higher because you're in a higher tax bracket. So it means your savings on your negatively geared property are higher if you are in a higher tax bracket. So essentially make it easier to hold on to these appreciating assets, build your property portfolio, get those reductions, and obviously the aim of the game is to enjoy capital growth over that journey, okay? So, and as you hold on to these properties for longer, as capital growth goes up, maybe rents go up, maybe you pay down a bit of that loan, the property can get closer to neutral territory, neutrally held, and get into maybe even positive territory. Now, and this is more accountant territory and maximizing the strategy for you and what suits you and your investment goals. But essentially, as property prices go up, you're building in capital growth into these assets. Potentially as rents go up, maybe you've paid down some of your loan, and potentially you're getting into that space, negatively geared, positively geared, and you're actually making a clear income from the property. But that's where potentially you and your accountant work on restructuring and potentially making some losses so you can actually bring down your taxable income. But that's for the accountant.
PK, how's the negative gearing help the property developer?
Bonnie, great question. As always, we have plenty of clients that develop and hold their asset. I'm working with a couple right now on a buy, develop and hold strategy. Essentially with those ones, Bonnie, we're creating capital growth as well. So we're not waiting for capital growth, we're creating it. So an example, we've got a client, we buy a little property, we do a dual occupancy development, a couple of single stories, and essentially create equity through the development process. Over that circa 18-month, 2-year period, we create, call it $250,000 in equity uplift, but then they rent them out at the end, and then essentially they can engage that negative gearing strategy, which is awesome. I guess the thing is, when you property develop and you create equity inside the asset, you turn one property into two, you're getting two rents instead of one. It's a brand new property instead of maybe an older property, so your rents are higher. What we usually see is, depending on each client's leverage, you can get yourself to a neutrally geared, nearly positively geared position because of the uplift that you've created inside the development, which makes it a lot easier to hold. But in saying that, again, back to the accountants, but if you can leverage up those assets to a point where maybe you do tip into the negatively geared space, pull out the equity and roll into something else, and that's where you can take advantage of the negative gearing. But for me, I love the idea of buying something old, putting 2 new ones on it, getting somewhat to a neutrally geared space, and not having much negative gearing in it, to be honest, Bonnie, because you've created this uplift and this capital growth, and your rental yield's really quite strong because you're renting out 2 brand new ones instead of maybe 1 aging property. Okay, Bonnie, so let's wrap up the negative gearing a little bit. It's a fantastic strategy. It's an age-old strategy. You obviously get yourself in the property market, build your portfolio, and it gives you the ability to build that and get some tax benefits, get some money back, and help you build your portfolio. Hopefully progressing into a space where it is positively geared one day, but it does help people get on the ladder. It is a bit of short-term pain for long-term gain, Bonnie. So negatively gearing, in essence, means you are losing from a cash flow perspective, and you are losing from a cash flow perspective. Even if you're down $10,000, $20,000, depending on your situation, per year, and you are taking that off your tax for a $10,000 loss, you still got to find $6,000 if you're in that 40% tax bracket. You've still got to find $6,000 per year, Bonnie. So you're still losing. But over here, capital growth is outpacing the losses over here. That's the plan anyway. But yes, negative gearing, everyone knows, pretty clear, age-old way to invest in property. And potentially, if we're going to go on a good cycle at the moment, Bonnie, buy now, next 3 to 5 years, capital growth goes up, rents are on the way up. Happy days. All right, guys, let's get into the next one. Houses versus units from an investment point of view. And this feeds into the previous commentary around negative gearing, Bonnie, because depending on how you hold them and what asset you buy, it will change the ability for that asset to have capital growth, and it will change what sort of yield you can expect from each asset. All right, let's get into it. Houses versus units. Now, units, stronger yields, Bonnie. Houses, lesser yield. So let's give you some stats. Melbourne houses at the moment, as of 2025, the yield's around 3.5 for houses. Units, 4.7. So a genuine uplift there when you're talking yield. So it's going to be more cash in your pocket. And for me, the apartment yields sort of get you a bit excited and get you in and go, hey, let's go. It's going to cost less to hold us. We're a good option. For me, the capital growth is where you win. The capital growth, once it's up and running, will outpace any of these losses. You look up CoreLogic, over the last 30 years, property prices have gone up on an average of 8%, Bonnie. Now, obviously, each year it doesn't go up 8%. Average, long-term, 30 years, it's not a bad sample size, Bonnie, 30 years. 8% on average here in Australia. So if you work on those numbers, even if you pair it back, Bonnie, to 5%, if you've got $1 million property and it's going up 5% per annum for 10 years, and that's compounding. So in the first year, it's $1.05 million. Second year, it's $1.11 million. And compounding. I think your calculator before, Bonnie, suggested maybe just under doubling. Okay, so that's not financial advice. No one's got a crystal ball, let alone me. But that capital growth gets quite aggressive compared to the holding costs over here. So Bonnie, if you're losing $20,000 per year over in the negatively geared area for 10 years, that's $200,000. If you're in a tax bracket of around 40%, it's not $200,000 loss, it's a $120,000 loss because you've claimed that 80 back. So you've lost $120,000 over 10 years. And if this property, we're talking 5%, the average is 8%. So essentially the capital growth over here going up 5% per annum on our $1 million property, Bonnie, going up $50,000 per year. And remember, that's got to be a compounding calculation. So over 10 years, with no compounding, it's 500,000. Compounding, maybe we're talking 600, 700,000. So definitely a good win for that person who's used negative gearing to get into the market and get that capital growth. Now, going back to units versus houses. Units will grow at a slower pace than houses because simply there's less land component. As we know, land appreciates. Units, there's multiple of them. And as we know, developers keep developing units and apartment blocks as they go. So as apartments get older and the new ones get built, they become less attractive to either tenants or buyers and these types of things. So the supply demand metrics sort of hurt you in the unit space. In the houses space, they're not making any more land. So if you can buy land, if you can buy a home, that's always going to be the premium asset to have your hands on. Now, I understand that units are cheaper and you can get into better suburbs at a cheaper price point because you're buying units. For mine, get further out, get into the regional centres where your budget works and buy something there that's going to appreciate, it's going to have increased land value, and is always going to be sought after. Homes for owner-occupiers are always going to be sought after. The owner-occupier market will keep paying more, and that market grows because they're the ones that need that asset. When it comes to apartments, and if you're dealing in more so the investor market, investors will just play the numbers. They'll play the numbers, they'll play the yields, so they're not as emotionally vested in getting that asset like owner-occupiers are trying to buy homes. So you need supply and demand metrics to be in your favour, and when it comes to houses, those metrics work in your favour because they don't really make any more land. Yes, you have land subdivisions, but when you're buying in these reasonably good pockets, close to train stations, close to transport, like we say, they don't make any more of those. The ones they make are further out and less desirable. So anyway, there we go. All right, guys, so let's wrap this up. In summary, we've got the negative gearing on this side. I guess just some tips there. Make sure that when you are going into these investments, or you do hold these investments, make sure you do the work and do the due diligence to figure out what all the costs are going to be. Because the strategy of this and negative gearing and bringing your tax down and capital growth, it's all great. It's all great in theory, but the cash flow is super important. So you got to appreciate what are the costs. Land tax, make sure you appreciate that. Get your calculations right and your estimates right. Make sure you're looking at your property management fees, your maintenance, your rates, things like these. Make sure your spreadsheet is filled in and make sure you leave some contingency there for when interest rates fluctuate either way. And if interest rates are on the way down, which hopefully we're in that cycle right now, but if interest rates go down, maybe it's a good time to shift some of that across and make sure you're keeping that buffer for a rainy day, for when the air conditioning breaks in that investment property or the heater breaks in that investment property. Okay, so that's the tips for the negative gearing. Make sure you get the costs right. And as far as houses versus units, I'm firmly in the houses camp as a long hold strategy and get a part of that capital growth, because in the greatest country in the world, they're not making any more land. You get yourself a bit of land with a house on it, happy days. But remember, do the calculations, do the negative gearing, do the calculations, and make sure you're covered, and make sure you can hold it and sustain whatever it is lifestyle that you expect to sustain, but make sure you can sustain that and live on comfortably. All right, guys, thanks for hanging around for this long. Please, if you're doing a knockdown rebuild, dual occupancy or multi-unit development site, book a consultation. Get across to Instagram, say hello, and make sure you become a fish in the Little Fish Network. It's free, an amazing community in there. It's Australia's biggest property community. Get in there for free, learn something, and rub shoulders with some of Australia's best minds and the most amazing community. All right, guys, have a great week in property. See you next Monday.